All right, welcome back to Module 8. In this module, we're going to be talking about prioritizing debts to pay off. So let's go ahead and dive in. Now, like in every module, I have to share the disclosure. I'm not a licensed attorney, accountant, financial advisor, real estate broker, real estate agent, or any other licensed individual. This is just an amazing strategy that I want to share with you. It should not be construed as specific counsel, advice, or instruction that would apply to specific individuals. This is just intended to be general information for educational purposes. So with that understanding, let's go ahead and dive in and talk about how we're going to prioritize how we're going to pay off these debts. So this is particularly important when you're using the chunking method because you're going to be paying off kind of one or two or three debts at a time. We need to know which debts are going to be the most important, and the answer is cash flow. A lot of people think it comes down to paying off the highest interest rate ones first. That isn't necessarily true. Like I said, interest rates do not pay off debt. Cash flow pays off debt. So what we want to prioritize is which debts are going to reward us with the highest cash flow so that we can pay off the next debt even faster. Sometimes, it might work a little bit backwards. The higher interest rate ones may not get us the highest cash flow, and that will result in it taking longer for us to pay off our debt, which means we'll end up paying more interest overall. So don't be fooled by the advertised interest rates. That is the biggest folly of people who are new to speed banking, is they still just are focused on those advertised rates. It has nothing to do with the advertised rates. We're going to focus on cash flow index. So let's talk about what cash flow index is. It's a simple equation. You run a cash flow index for each and every debt that you have, and all you do is you take the monthly payment and divide it by the remaining balance. That will return a percentage or a decimal. So with each debt, I recommend, write down on a piece of paper all of your debts that you have and what your payment is and what your balance is. And then make a column for CFI. You're going to take the payment divided by the balance, and that will say the CFI. It's going to return a decimal or a percentage. Prioritize the highest debts first. So pay off the higher CFI debts first. You're looking at that CFI column. It's the higher numbers that you want to pay off first. Think of this as purchasing cash flow from your debt. You're calculating a return on investment. So for example, we'll use some extreme examples to prove my point. So if you've got a debt that is $100 a month, but it's a $100,000 balance, that is probably going to have a much lower return on investment, or CFI, cash flow index, than something that is $200 a month and only has $500 left on it. Because you're going to pick up $200 a month by spending $500 versus picking up $100 a month by spending $100,000. So whether that's out of your line. So you're calculating the ROI, which debt is going to give you the most cash flow by paying it off. Interest rates, again, do not matter when calculating CFI. I would say zero interest. You might want to save those. Again, this is an exception to the rule, right? If you got a 0% interest line or loan, you might want to push that one to the back just because we already know that we're not paying interest on that. So the whole goal of this is to bypass the amount of money that we spend in interest. So the only advertised rate I would pay attention to is if it's 0%, push that one to the back regardless. But interest rates, and again, you may want to run your CFI because you may be able to pick up some serious cash flow doing it. So this is one of those points where, there's a rule, but here might be an exception to the rule if the interest rate is 0%. Still do the math, still see which one's going to be better for you to push that to the back or to the bottom of the priority list as far as debt payoff, or to just go ahead and pay it off and pick up that cash flow. So again, you're going to have to use your judgment there. Interest rates, remember, interest rates do not pay off debt. Cash flow does. So the most important thing we're going to focus on is cash flow. And that's what the cash flow index tells us is which debts are going to reward us with the most cash flow so that we can pay off the next debts even faster. Now, let's talk about good debt versus bad debt for a second. You definitely want to pay off the bad debt before the good debt, because if it's good debt, we're talking about assets such as rental properties or business debt. This is any debt associated with something that directly brings you more money than it costs each month. So the reason good debt should be prioritized after bad debt, and you should kind of run two separate CFI to micro prioritize the good debt and the bad debt. So you're taking your bad debt, which is the stuff like the house you live in, your car, the hot tub that you bought, your credit cards, those types of things, medical debt, student debt, that's all bad debt. And the reason that the definition of bad debt here is debt that does not return you more cash on a monthly basis than you spend on it. Good debt is debt that returns you more cash on a monthly basis than you spend on it. So that's the only difference, is it paying for itself. And the whole idea there is if it's paying for itself, well, then it's not necessarily taking away from our cash flow. It's actually adding to our cash flow. So we'll prioritize that last. And some people may not want to pay off their real estate portfolios. I mean, there's definitely a strategy to carrying to carrying stripped equity on your real estate. So if that's one of your strategies, you may decide that you don't want to pay off your good debt. You just want to pay off your bad debt. If you want to pay off both, definitely prioritize the bad debt first. So let's go through this list. Let's start with good debt. These are assets such as rental properties, business debt, any debt associated with something that directly brings you more money than it costs each month. Run a CFI to micro prioritize your good debt. So you should have a separate sheet for your good debt. Pay off good debt after bad debt. So pay off the bad debt first. Let's go through bad debt. Bad debt is debt that is used to buy liabilities. So it'll be such as credit cards, school loans, your personal residence, your car, etc. We went through a list already. Run a CFI to micro prioritize your bad debt, and then pay off the bad debt before the good debt. So when we're looking at how to prioritize your debt payoff, we're going to run a CFI on everything. Separating the category of good debt versus bad debt, we're going to focus on the bad debt first, starting with the highest CFI, working to the lowest CFI. Then we're going to go to the good debt, starting with the highest CFI, going to the lowest CFI. Hopefully that gives you guys a good understanding of how to prioritize your debts to pay off. This is especially useful if you're going to be using the chunking method. And that wraps up Module 8. In Module 9, we're going to be talking about how to operate speed banking on a daily, weekly, and monthly basis. So I will see you guys in Module 9.